Good morning, ladies and gentlemen. All right, I wasn't planning to record today. I had a quiet morning, went for a walk, grabbed a coffee, and tried to let the markets do their thing without me hovering over them. But then, something crossed my desk that I couldn't ignore. And I don't say that lightly. If this were just another chart, another opinion, another prediction, I would have waited. I'd have let it play out. But this isn't speculation. It's hard numbers, and what they're telling us is rare and urgent. So, for the next few minutes, I need you to step away from the noise, the hot takes, the endless scrolling. What I'm about to show you comes straight from the other side of the world, and it matters more than anything you're seeing on your broker's app right now. For anyone new here, I'm Jason. I focus on what's happening beneath the surface. Not hype, not narrative, just where the stress is building before it shows up in price charts. And right now, that stress is showing up in silver. Here's the number you need to focus on. The front month physical silver contract on the Shanghai Futures Exchange just settled at 18,145 yuan per kilogram before their holiday break. Converted to dollars using today's exchange rate, that's roughly $80 per ounce. Now check your app in the US. Silver is trading at around $71 per ounce. Do you see the problem? A $9 difference might not seem huge at first glance, but in professional trading, this is massive. Normally, arbitrage, the process where traders buy silver where it's cheap and sell it where it's expensive, closes gaps like this almost immediately. Except this one isn't closing, it's getting wider. And that tells us something important. This isn't a pricing issue, it's a physical availability issue. Most of the silver in New York isn't actually sitting in a vault waiting to be shipped. It's paper, futures contracts, digital claims, promises of delivery. Meanwhile, Shanghai is dealing with physical metal, real bars, real settlement. And right now, physical silver is in demand, and that demand is crushing the system. Let's slow down the math so we all understand the scale. Shanghai settled at 18,145 yuan per kilogram. Converted to USD, that's roughly 2,500 renminbi per kilogram. Silver is measured in troy ounces, and there are 32.15 troy ounces in a kilogram. That makes the Shanghai price just over $80 per ounce. Meanwhile, New York remains around $71. If you're a professional, the question is immediate. Why isn't every hedge fund, every bank, every algorithm buying silver in New York and selling it in Shanghai? That's free, risk-free profit, yet it's not happening. The answer is simple and alarming. The silver isn't there to move. Physical inventory in New York is already being drained. Registered bars, the ones that are guaranteed for delivery, are disappearing. And on top of that, logistics chains are overloaded. Shipping, insurance, and delivery, everything is maxed out. This is why the arbitrage mechanism has broken. The gravity that normally keeps global silver prices in line is off. And here's the kicker. Timing is everything. We're heading into the lowest liquidity period of the year. Thin order books, reduced staff at exchanges, algorithms are running without much human supervision. In the meantime, China is aggressively securing physical metal, paying whatever it takes to lock up supply. That $9 difference, it's not going to disappear by itself. It's a magnet, pulling the US paper price toward reality. And when the gap starts closing, it's going to do so quickly and violently. But before we get to the explosive price mechanics, we need to understand why China is willing to pay these prices. This isn't retail speculation. This isn't a bubble. This is industrial demand, solar panels, electric vehicles, and next-generation technology. China is hoarding silver because its factories need it. Without it, production stops. Without production, revenue stops. And that's not hypothetical, it's happening now. By the end of this week, the physical metal gap between Shanghai and New York will define the market for months ahead. And anyone who doesn't understand the root cause, industrial panic buying, broken arbitrage, and a logistics bottleneck, is only seeing part of the story. Now we're going to break down the exact sectors in China driving this demand, how much silver they're actually absorbing, and why it makes $100 not a prediction. It's a mathematical inevitability. You now see the gap, $80 in Shanghai, $71 in New York, and a broken arbitrage system. But the question most people are asking is, why is China paying this much? Why are they hoarding at record prices? The answer lies in industrial necessity. This isn't retail buyers chasing charts or meme hype. This is factories, and more factories. Let's start with solar panels. China produces over 80% of the world's solar panels, and silver is a core component. For years, analysts kept saying, don't worry, silver demand will drop. They'll use less, substitute copper, or improve efficiency. That narrative is dead. The consumption per panel has stopped declining. And now the industry is transitioning to high-efficiency TOPCon and 8JT panels, which require 50% to 80% more silver per unit. That's right. While the world sees an $80 price, China is looking at a shortage of raw material that could shut factories down. Here's the kicker. Factories are bypassing traditional supply channels. They aren't waiting for refiners or secondary markets. They're taking delivery directly from the Shanghai exchange, grabbing bars by the kilo, melting them into paste, and feeding production lines. This is a panic hoard, and it's happening in real time. Next, let's talk EVs, the electric vehicle boom. Reports have been circulating about next-generation solid-state batteries like Samsung's new tech. These batteries aren't graphite-based. They rely on silver carbon composites. Standard EVs use 20-50 grams of silver per car. Solid-state EVs, up to 1 kilogram per car. That's a 20-50x jump in silver demand. And China isn't waiting. They're strategically hoarding silver at an industrial scale, millions of ounces at a time. BYD, NIO, and other manufacturers are in Scientia buying for immediate production. They were locking up supply for 2027. Think of it like lithium in 2021. Buy the supply before anyone else can. So what does this mean for the market? Let's look at Shanghai Futures Exchange warehouse stocks. In 2021, December 23rd, they held over 3,000 tons. Now, less than 800 tons and falling fast. That's a 75% drawdown in visible inventory. Registered bars, the ones available for immediate delivery, are practically zero. And this is why we're seeing backwardation. Normally, future prices are higher to account for storage costs. Right now, the spot price is higher than the future price. Factories are screaming, don't promise me a February delivery, give me metal today. Backwardation is the heartbeat of a physical squeeze. It signals immediate scarcity, not speculation. Meanwhile, over in the West, traders are still staring at charts and dollar indexes. They think silver is just a commodity or even a currency. They don't see that Shanghai is setting the real price, and the West is playing catch-up with paper silver. Here's the key takeaway. Every ounce sold on COMEX at 71 Mars is being physically shipped, refined, and delivered to China. It's disappearing from Western vaults. And with New York's holiday thin liquidity, any sudden industrial buy hits an almost empty order book. That's when the paper price gaps violently upward. Let's recap what's happening in simple terms. Solar panel demand is fixed and growing. Efficiency improvements now require more silver, not less. EV production is about to explode silver consumption by orders of magnitude. Solid-state batteries are game changers. Inventory is collapsing. Warehouse stocks are down 75%, and registered metal is almost zero. Backwardation is telling us the spot market is physically tight. Factories will pay whatever it takes. What does this all mean for the $9 Shanghai premium? It's not a fluke, it's a pressure gauge. The gap between East and West is going to force the US paper price to move. And when it does, it's not gradual. The next move could be violent, fast, and unavoidable. Now, let's talk about what happens next. The West is on holiday with thin liquidity. Most senior traders are out. Desks are being run by skeleton crews or algorithms. And the algorithms don't care about holidays. They only see numbers. When the Shanghai price confirms $80, the New York systems will try to close the gap automatically. They will chase the price higher, bidding paper silver up just to match reality. But here is the problem. The physical silver to execute the trade simply isn't there. Vaults are drained. Registered inventory is at historic lows. The paper price can't touch the metal. It can only chase it. This is where the squeeze becomes dangerous. Large industrial buyers like BYD or major solar companies place big orders to secure their inventory. With so little metal available in the West, the order book instantly empties. Prices skip from $72 to $75 to $78 in minutes. There's no friction, no slow adjustment, just a vacuum being violently filled. Meanwhile, banks and future sellers are trapped. They sold options at $72 or $75. As the paper price gaps, their automated risk engines force them to buy more futures to hedge losses. Buying pushes prices even higher, creating a feedback loop that accelerates the move. Retail investors watching on their broker apps may panic. The price spikes. It seems irrational, but it's not a bubble. It's reality catching up with paper markets. The $71 price was never real. It was an illusion sustained by available inventory and the suppression mechanisms of Western banks. That ceiling is gone. The psychology is critical. CEOs in China see a $9 spread. They aren't speculating, they are calculating. If they don't secure 6 months of supply now, factories will stop. That urgency is translating into hoarding on an industrial scale, and it's accelerating the disconnect. The implications are massive. Once the paper price meets the Shanghai spot, that $80 becomes the new floor. And $100? That's no longer hype. Considering solar, EV, AI, and strategic industrial demand, plus shrinking inventory, the market is being pushed toward triple-digit silver. Every day the gap remains, the imbalance grows. If you're a retail investor, the question is how to navigate this safely. Physical silver is the real asset. Futures contracts or ETFs can be liquidated, but physical metal cannot be created or teleported. As the Western paper price reacts, supply shortages will make actual ounces harder to acquire. Prices on online dealers and local coin shops will reflect reality, not the screen price. And here is the most important part. Don't anchor your thinking to old price norms. $80 isn't a T high anymore. It's cheap relative to the industrial imperative and the scarcity unfolding. The ratio of gold to silver, the global demand, the broken arbitrage system, these are the real measures. Selling now is giving up a strategic asset for a depreciating currency. The next phase is clear. Ghost week or not, algorithms will push paper prices upward to match Shanghai. Physical shortages will persist. The industrial squeeze will continue. And if you're prepared with ounces in hand, you're positioned for the inevitable re-rating. This isn't about chasing a pump. It's about understanding a structural shift in the global silver market. For decades, Western banks dictated prices using paper contracts. Today, China and industrial buyers are rewriting the rules. The metal itself is now determining its value, and the paper market will have to catch up. We're witnessing the end of paper-silver supremacy. The pricing power has shifted, and the real move is just beginning. $80 was a wake-up call. $100 is the natural next step, driven by supply constraints, industrial demand, and a broken arbitrage system. The only question left is how quickly the paper price can keep pace with the physical reality. By now, it's clear that something big is happening. Western markets are trying to price silver as if the old rules still apply, but the reality is on the other side of the world. Physical silver is being hoarded, processed, and locked away in China, and the gap between paper and real silver keeps growing. Factories, solar manufacturers, and EV producers aren't speculating. They need this metal to keep their operations running. If they don't secure it now, production halts, contracts slip, and workers sit idle. That pressure is pushing the market into a perfect storm, soaring physical demand while Western liquidity collapses. For investors, this is the critical point. If you hold paper silver or ETFs, you're exposed to sudden swings and thin market volatility. But owning physical silver gives you a clear advantage. You're insulated from flash crashes, ghost week gaps, and algorithmic chaos. This is about protecting real wealth in a market where paper promises are increasingly unreliable. Timing is everything. The East is calling the shots now. Broken arbitrage, empty vaults, and industrial hoarding mean prices will jump sharply and unpredictably. $80 was just the start. $100 isn't speculation, it's the logical next checkpoint. And beyond that, scarcity and industrial dependence suggest even higher levels are coming. Here's the bottom line. Don't get distracted by charts or headlines. Look at the fundamentals. Supply is tight, demand is relentless, and the paper price is disconnected from reality. Physical silver is where the truth lives, and that's where you want to be paying attention. And finally, remember this. Markets move fast, but they always follow reality. Silver isn't just a commodity or a speculative play anymore. It's a critical industrial metal, and its value is now being set by the people who actually need it. The old Western control is over. Shanghai, Shenzhen, and the factories of Asia are now setting the benchmark. So what do? If you can, secure physical ounces now, watch the supply chains, study industrial buying trends, understand that the next big moves will happen when the market can no longer ignore reality. All right, that's all for now. If you found this useful, hit like, subscribe, and turn on notifications so you don't miss the next update. I'm Jason, and I'll keep you ahead of the silver game. See you in the next video.